Hi, everyone. Thank you so much for joining and welcome to our Financial Clarity on Autopilot webinar today. Today, we're going to be covering how to master your cash flow without becoming an accountant. So firstly, I'd like to let you know that this webinar is being recorded, so you can rewatch it later if you don't have time to watch the whole of it today. And also, if you have any questions throughout the webinar, feel free to ask them on the questions box down below. We're going to have a Q&A session at the end, so make sure to stay till the end if you want your questions answered. Now, I'd like to introduce you to our speakers today. We have William Chong, who is our CFO here at Awesome. We also have Mohsen Ali, who is our Senior Accounting Manager, also here at Awesome. And we also have Anthony Sati, who is Legal Vision's Head of Legal and has over 10 years of experience as a general commercial lawyer, and is going to be also featuring in the webinar today as we are collaborating with Legal Vision. So on today's agenda, we have quite a lot to cover. We're going to cover understanding the difference between profit and cash flow, the 3 pillars of clean books, key financial statements every UK business needs, how to protect revenue in your client agreements, raising capital quickly, third-party financiers, loan avenues for helping with cash flow, and key UK compliance deadlines you can't afford to miss. So before we go ahead, I'd quickly like to ask you, how do you feel about your company's cash flow right now? We are going to be doing a little poll that's located in the chat box. So if you want to go to the chat box now, you'll be able to see it and make sure to vote your answer. Okay, now without further ado, I'm going to leave it with you, William.
Hello. Good morning, good afternoon, good evening, everyone. I guess we have a global audience here, and I just forgot to unmute myself. Sorry about that. So just a very quick introduction about myself. I have been in startups for the last 10 plus years and have helped companies, startups raise over $100 million of my career. Have served very early stage company, pre-seed, to all the way to Series D. So why is it important to differentiate profit and cash flow? I think as a founder, you might always hear people talk about profitability, right, which is a very important metrics in the eyes of investors. But don't underestimate the importance of cash flow, because when it comes to the ability of the company to continue to operate in the short term, your cash flow actually is the most important metric. So when we are looking at these two business metrics, profit tells us whether there is a long-term viability of the business, whether you can generate enough margin to pay your employees, versus cash flow gives you the liquidity that allows you to pay your employees tomorrow. So the two metrics are also driven by different underlying drivers. Profit, for example, largely rely on your efficiency of your business, whether the team can deliver things more with less, and then of course, your margin, right? How your pricing, how you charge your customers. And then in terms of cash flow, the additional factor that you need to consider is your payment terms. Whether you have good payment terms. For example, why people love SaaS company, because typically they have a very strong cash flow upfront. So when you think about designing your business model, these are very important consideration. Lastly, profit typically more complicated and more complex to measure. So it requires some form of accounting knowledge, versus cash flow is pretty straightforward. You have your money in, money out. Right? So that's why when it comes to managing your company finance, it's always good to have like a professional to help you look after both metrics, profit and cash flow. And to get it started, you need very clean and accurate information to start with. Now, what do we mean by clean information. So we want to talk about the three pillars of clean books. First of all, you need to have a complete set of records to start with. If you are paying your suppliers, but you have no idea how many invoices you have received, then something is wrong. Perhaps start to think about tracking a set of records. And the next step is to reconcile them, because you have actually two set of records. You have all this paper trail, like your invoices, and your for example contracts. But then you also need to reconcile them with your bank statement, right, which is related to your cash flow. And lastly, making sure we have regular reports. So you have a review of your results regularly, to keep you up to date of the health of your business. Now, a lot of times when we are thinking about our books, I think in the past you might still need to think about going to an accountant, give them all the physical copies. But nowadays, I think in a lot of countries, whether it's a business, government, or individuals, we are trying to go with digital. And so automating your book through digitalization is a great way to improve your productivity. And at the same time, it also relieves you as the business owner from a lot of the administrative tasks. Nowadays, there are more sophisticated technologies available. I think back in 5-10 years ago, people were talking about OCR. They can scan your copy, recognize the text. Now, I think with AI, the AI agents are able to follow certain patterns and do the reconciliation, right? Getting better and better. Reconciliation is something that we need to do regularly, and I strongly advise not to wait until end of the year to do it once, because then you will actually pile up a lot of the work towards the end. And if you spread it out, perhaps you will have an easier time throughout the year to monitor the health of your business. You may have encounter a situation where your books tells you have £10,000, but in your bank you only have 8,000. So this type of reconciliation require I think regular efforts, and that's why I think taking care of them on a regular basis helps. And business expenses, there are different categories, different natures, and these natures will affect the tax position of your business, and that's why having an accountant to look after this and advise you how do you consider the nature of these spending will be important. You don't want to file to the tax authority and 2 years later tell them, sorry, I made a mistake and want to make a change. So always keep the records update, accurate, and complete, so you can have peace of mind. Lastly, I think as a CFO, I always, I think tell the CEOs or founders that the most important three financial statements would be your balance sheet, which tells you how much you own, how much you owe, basically how the level of assets and liability that you have, and your P&L. Are you making money? Are you generating enough profit? Is there margin? And why is it particularly important? It's also because it determines how much you're going to pay the government, your tax. So making sure the P&L is recorded and also prepared properly is important. Lastly, cash flow. Making sure that you have a proper cash flow, not just to see how much money you have paid out or received in the past, but most importantly is to look at the future forecast of your cash flow, because it determines whether you will have a potential gap in your cash, and you always want to have 12 months runway at least, right, to get you enough time to raise funds or raise a debt, so you can continue with your business, especially in the early stage. Well, you might ask, I don't want to look at all of these financial statements. I don't want to look at all this, paperwork. What should I do? At Losum, we have a business health dashboard, which allows you to take a look at your business health in a quick glance. It summarizes all these important metrics, which are very important to your business, to the business health, so you don't have to spend a lot of time digging through those 3 financial statements. I think that's the end of my part, and perhaps I will hand over to Anthony.
Thanks, William. So today I'm just going to kind of run through some legal tools and structures that can help businesses with improving their cash flow and protecting their cash flow, because obviously cash flow is really the lifeblood of any business. Firstly, I think let's just focus on how do you protect cash flow and revenue in your client agreements. Obviously, the legal agreements will dictate how and when you get paid, and not having a written agreement with clients or having a really poorly drafted agreement with clients is going to potentially contribute to you not getting paid or payments being delayed, which can cause a little bit of a cash flow crisis. So some of the things that we can do to improve cash flow within agreements is to include certain key contract terms. So on the front of payment terms, we can ask clients to be paying either deposits or certain amounts up front, with other amounts upon completion of services, or even as something as simple as, instead of asking clients to be paying maybe their subscription in arrears, asking their monthly or quarterly payments to be made in advance. Naturally, we can cover things off on the actual payment terms themselves, and our expectations on when invoices are to be paid, whether that's 7 days from invoice date or 7 days from end of month, stuff of that nature. We can deal with automatic renewal clauses to make sure that client contracts are continually rolling. Obviously, there'll be some notice periods in there to allow them maybe to terminate before renewing, but that's obviously going to help secure recurring revenue and kind of takes out a little bit of the administrative burden in having to approach clients constantly to enter into brand new contracts. You can, again, help with cash flow by having certain price increase clauses, depending on the industry that you're in. You could, be pegging price increases to either some sort of fixed amount or CPI. Another way to ensure that you're kind of protecting revenue is on certain without clause termination rights. So often you'll see that contracts will say that a client can terminate with 30 days notice. Extending those periods out to 90-day periods gives you a chance to replace that revenue with new clients if an existing client wishes to terminate. A very administrative, pragmatic way of dealing with securing revenue is just making sure that potentially you've got direct debit arrangements with clients. Again, reduces some of the administrative burden for you. And if you're in the space of SaaS products, offering maybe some trial periods to clients, making sure that those trial period terms are really clearly drafted so that clients are only legitimately getting out of their contracts within that trial period. Some other key provisions center around enforcement. So actually, if a client doesn't pay you on time, then including some sort of a late payment or interest that's applicable to them. You do usually have rights, statutory rights for interest payments, but it's always good to kind of bake that directly into the contract as well. Clear suspensions right. So if a client doesn't pay you or otherwise breaches the agreement, then you've got some sort of right to suspend the provision of services until they've paid you. And obviously that helps with, you not absorbing further costs in servicing that client until they've paid you. Again, depending on the circumstances of your client and the business that you're in, you could be in a situation where you're asking for certain security, whether that's some sort of personal director's guarantee, maybe for certain SME clients, or maybe a charge or a debenture. So for example, if you're in the space of equipment hire, then you're obviously giving that equipment, the title to that equipment over. You're wanting to retain that title, giving the possession of that equipment over to the clients, and so you might want to protect yourself from the repossession of those goods by making sure that there's a charge over that asset. Obviously, another way that cash comes into the business is through raising capital. And obviously, when we're talking about raising capital, we're mainly talking about largely the issue of shares in a company. But there are other ways to get cash into the business. And the problem that you often have in raising capital is how long it takes for that cash to come in. Particularly if you're doing, I guess, a traditional capital raise, potentially with venture capital or private equity or other sophisticated investors, it can potentially take a long time from start to finish for that to be finalized and cash to actually hit your bank. So what I wanted to talk to today about is just some of the ways that you could potentially raise capital in a more quicker way. So the first is actually just approaching your existing shareholders. So instead of looking external and trying to get a VC in, or getting another sophisticated investor, approaching your existing shareholder base and offering them the opportunity to further invest in the company. And for a lot of those shareholders, they already know the business. Due diligence isn't going to be really required. You potentially are using the same documentation that they used in a previous round, and you potentially also just negotiating with one lead investor again, and that process is going to be a lot quicker than going externally. Another way to obtain investment is through what's known as a SAFE, which is called a simple agreement for future equity. In the UK, we call that an advanced subscription agreement. A SAFE is something that came out of the US. And it's going very quickly in the UK in terms of traction and companies using it. The key advantage of a SAFE versus what we're going to talk about in a moment, convertible notes, is that it's actually a relatively short form agreement, and the concept itself is quite simple, so it doesn't require that much of negotiation. The basic concept of a SAFE or an advanced subscription agreement is that an investor gives money to the company. That money is not considered a loan on the bank on the books, and there is actually no final repayment date of that money. That lump sum of money only converts into shares at some future point in time, based on some sort of liquidity event or trigger event. And usually, what we're talking about there is another capital raise, or a sale event of the company, or an IPO. So if any of those events happen, then that lump of money will convert into shares into the company. Now, obviously, that instrument is a little bit risky for investors, but the way that investors kind of benefit from that risk is that they'll usually receive a discount on the share price that it gets converted into. So that's really the advantage to them, is that their amount of money will be able to convert into a greater number of shares, because they're being rewarded for investing early into the company. And these type of raises, you're typically talking about raises between the £50,000 to £500,000 mark. And as I said, they're really relatively quick to negotiate and implement, with not that many kind of complex terms. Another form, which is very similar to a SAFE, is a convertible loan note. It is a bit of a longer document, and as the name suggests, it actually is a loan, but it works in a very similar way, in the sense of an investor loans money to the company. That loan then potentially converts if there is, again, some sort of liquidity event. Otherwise, if a liquidity event doesn't happen, then usually the lender gets to either convert that amount on the maturity date to shares, or simply ask that money to be repaid in a standard loan. And those concepts of discounts will also apply. But generally, the benefit of, again, convertible loan notes is that they are vis-a-vis a normal capital raise. They are much quicker, and there's less negotiation that's involved. Convertible loan notes will have interest like a normal loan, and they may be the subject of security as well. But as I said, generally a speedier way to raise equity. And then finally, just a general kind of tip from my end on how do you make sure that if you are doing a traditional capital raise, maybe with a sophisticated investor, how do you make sure that process is shortened? Because sometimes that capital raise can take 8 to 12 weeks from start to finish. And I think one of the approaches is making sure that potentially, depending on what round you're at, maybe not going through sophisticated investors, you're just doing a friends and family round if you need cash quickly. But if you are negotiating with an investor, then making sure your data room is complete and up to date before you've even started negotiation. You've dropped all your material contracts, corporate governance, IP information, accounts information, all into a data room for DD to occur. You might want to make sure that your shareholders' agreement and articles are balanced and ready for investment, that they're fair. Often sophisticated investors will want their own documentation, but if you can put together with some legal advice a balanced and fair document, then it might be the case that they're just looking to make some simple amendments to that document instead of reinventing the wheel. Otherwise, potentially use standard form documents like templates from the BCBA on term sheets and subscription agreements. And I think just generally having an approach of understanding market standards to certain risk and liability points. So in terms of negotiating warranties and liability caps, having a lawyer there that understands capital raising can give you advice on what is market standard so that you're not over negotiating those documents. And then lastly, just again, another mechanism or an avenue that businesses can use to try and improve cash flow is considering third-party finance, particularly what's known as invoice financing or factoring. So there is two main types, which is, as I said, invoice factoring and invoice discounting. The basic concept of these types of loans is that you've got cash flow tied up in basically future revenue. So for invoice financing, you've got that fundamental problem of you've done work for your client, you've raised an invoice, but you're not going to get paid for 30 odd days or 60 days or even 90 days. And your business still needs to operate, still needs to pay employees and other business expenses. So invoice financing will kind of solve this by you getting about 80 to 90% of the invoice value within one to 2 days. So I've got a little bit of an example there on the screen of, let's say you build a client £100,000. You've got 60-day payment terms. You'll receive from the relevant third-party financier about £85,000, so 85% of the invoice value. The customer will then pay that 100K on day 60 at the end. So you receive the 15K minus then the fees that the bank obviously will charge to get their slice of the pie. So you're effectively getting a much larger amount of money really quickly, 58 days earlier than your standard payment terms. Factoring is very much similar, except that whereas in invoice discounting or invoice financing, the the kind of onus is on you to make collections and chase clients up. With factoring, it's the lender that takes over your sales ledger. They will chase payment, handle queries, invoice kind of clients and chase it. And then otherwise it works very similar to invoice discounting. It works obviously quite well if you're a smaller organization and maybe you're struggling with having a proper credit department. So again, administrative assistance, but obviously you pay for the privilege in having the bank kind of take that role, and certainly the fees are usually a little bit higher for the factoring side of things. And obviously, when you're negotiating these type of deals, a lot of the negotiations will center on what are the fees that are payable, what are the interest rates that are payable, are personal guarantees or other security required of you, and most importantly, is it a recourse facility? So most of the facilities are full recourse, which means if a customer ultimately doesn't pay, but the bank is obviously drawn down, then you're still ultimately, commercially liable and legally liable for that risk. And yeah, so look, I will leave it there, at least on the legal side of things, but hopefully that was kind of helpful on some of the ways that we can secure cash flow in your business. And I guess quite a nice segue into the next topic of just generally, how do you make sure you're complying with your relevant cash flow obligations in the UK?
Okay. Hi everyone. So today I'll be covering off a bit more about compliance for UK companies. So firstly, let's talk about the two bosses that every UK limited company has to answer to: Companies House and HMRC. So both of these bodies want different things and also at different times. But missing a deadline, it can become super expensive very quickly, with penalties racking up separately for both entities. So starting firstly with Companies House, we have a confirmation statement. So this is an annual requirement for all limited companies. And what this is a file submitted to Companies House to confirm that the details of the company are all up to date, which includes your directors, your shareholders, the registered address, etc. So please do not ignore this. You normally do receive a letter in the post and also an email from Companies House reminding you of the confirmation statement becoming due. The reason why I say do not ignore it is because if it's not filed, Companies House can assume that the company is no longer trading and they can begin strike-off action. And once the company is struck off, please remember that any remaining assets can pass straight to the Crown. And to restore a company, the process can be very, very lengthy. In terms of assets, this can also include the funds that are currently sitting in your business bank account. So the funds can get frozen, they can be taken away, you'll have no access to your business bank account if the company is struck off. So be very wary of that, because I've seen cases like this before and the process becomes very lengthy. And as a business, you do require the cash available. And if you end up losing that because of your company being struck off, it can have obviously negative impacts on your day-to-day running. Next up, we have the annual accounts. So your company's accounts have to be filed within 9 months to Companies House. In the first year of trading, it's slightly different, where the deadline is 21 months from the date of incorporation. But after that, it's normally 9 months after the year end. Be careful, because the deadline is very strict. Even if you're 1 day late, you will receive an automatic penalty from Companies House, which, to be honest, cannot be appealed. Like, it's very difficult to appeal a penalty with Companies House. So please, I urge you to make sure that your accounts are filed on time. Next, moving on to HMRC and also corporation tax. Technically, you have 12 months after your financial year end to file the corporation tax. However, your tax payment is actually due earlier. It's due 9 months and 1 day after your financial year end. So you must pay the tax before the return is technically due. However, the advice is simple: even though the return is due after, as accountants, we normally work, and I would recommend every limited company owner to also work this way, is work towards a 9 months deadline for both accounts and tax. Because in practice, we work at this deadline rather than 12 months. It just makes sure that everything is on time. And normally, you will need to do your corporation tax return to compute the corporation tax. At that stage, you already have the figure, you can make the payment, and keep things very simple and keep in a safe zone to ensure you don't receive penalties from HMRC. So next up, we have VAT. So when do you actually need to register? It depends. If this does vary depending on where your business is established. So for UK established businesses, threshold is simple. It's £90,000, and you must register if your taxable turnover exceeds this in a 12-month rolling period. Some people do get confused that they think it's within the financial year or a calendar year, but in fact, it's a 12-month rolling period that if your turnover exceeds 90,000, you must register for VAT, or if you expect to exceed this in the next 30 days alone. For non-established businesses, it's slightly different, where there is no threshold, like it's pretty much zero. And what this means is, effectively, from your the very first taxable sale made in the UK, you must register for VAT as a non-established business. I would highly recommend do not ignore this, either one, whether you're a non-established business or a UK established business. If you should have been registered, please do register as soon as you find out, because HMRC will backdate the date of your registration. And it could mean that you end up paying the VAT that would have been due in the sales out of your own pocket, because ultimately you've not charged them to your client or your customer. And after you've been VAT registered, it can become very difficult to collect that from customers, from clients, because that relation may have ended. There may be some other factors to consider, and you may have to absorb the 20% VAT from your business profits. So please do be careful when it comes to VAT. Once you register VAT, most businesses will file returns quarterly. Some do file monthly, and a very small number of clients will use the annual scheme. For monthly or quarterly returns, both the filing and payment are due 1 month and 7 days after the VAT period ends. And that deadline applies to both the VAT return submission, but also the payment submission. For the annual scheme, you just file once a year. However, you do make advance payments during the year. It's usually 9 monthly installments or 3 quarterly installments, followed by a final balancing payment. Also, to be mindful that HMRC does have a new penalty-based system where each late submission gives you a penalty point. And once you reach the threshold, HMRC automatically issues you financial penalties. And these penalties do begin to increase quarter on quarter once returns are missed or payments are not made. So the longer you leave things, the more that these penalties for your VAT returns can increase. Compliance doesn't really have to be a headache. At Awesome, we provide a one-stop accounting service that ensures you pay the right amount of tax and, most importantly, never miss a deadline. We're always proactive in reminding you of key dates. We'll tell you exactly what information we need from you and when. And importantly, we handle the filings at our end. You don't have to worry about that when it comes to filings. Our intuitive, awesome app does become your financial companion as part of your business journey. You simply snap a photo of your receipt, upload it on our app, and it's captured, processed quickly. You also, and as William showed earlier, you get real-time financial insights through our business health dashboard, where once your documents are processed, you can see them insights in our dashboard, visible for you to make decisions. I remember when I used to work at a traditional practice where clients would bring physical bags of receipts into the office, and then we'd have to process and sort everything out manually, add things up, and it would mean that the client gets their reports months later, where in most instances, it's too late to make a decision. Whereas Awesome, we have our dashboard where everything can get processed and you can have real-time insights. So Awesome is very different. We automate the basic repetitive tasks. And what we focus on is what actually matters to founders, which is dedicated support, clear advice, and also peace of mind. Founders and business owners do not enjoy bookkeeping or tax filings from my interactions with them, because it creates added pressure. It creates a distraction from the day-to-day business. And this is where, as Awesome, we step in. We take care of all the processing, the reconciliations, the reporting, and also the submissions. So you could actually focus on growing your business. If you would like to see how we could automate this for you and simplify your compliance, please do scan the QR code on the screen. I'm confident that you will not be disappointed. Thank you for listening. That's all from me. I will pass the stage back to Anthony now.
Thank you. So just a little bit about Legal Vision. Just wanted to tell you a little bit about our model and our memberships services. By becoming a Legal Vision member, your business gets unlimited access to our full team of specialist lawyers for all your business as usual legal needs. It's basically like having your own in-house counsel for a fraction of the cost. Our team can assist you with unlimited document drafting and reviewing of business contracts, unlimited legal advice consultations, unlimited domestic trademark applications, and much, much more. As a Legal Vision member, you don't have to worry about the cost of lawyers pretty much ever again. We take care of all your business as usual legal needs, so you can just focus on running your business. And if you are in an in-house counsel, we actually do offer a dedicated service to manage your higher volume requests. To learn about our membership model or desk extension, you can actually request a free consultation with us by scanning the QR code.
Thank you so much, Anthony, for
Sure.
sharing that with us. And also thank you, William and Mohsen, for all the insights. So we are quickly going to head into our Q&A. We are conscious of time. So if you have any questions, feel free to submit them in the chat box. But we already have a couple questions that were sent to us prior to this. So we are going to go ahead and start answering them. So I have a question here, which I think would be best probably for William. How much cash should I actually keep in the bank?
Well, I think, as a owner, I always encourage business owners to have at least 12 months of runway. And how do you determine runway? Is basically looking at how much cash that you have burned over the last cycle. And it can be month, it can be a quarter, it can be a year, because every business has seasonality. So then based on that number, you kind of know how much cash you need in order to continue running the business for the next 12 months. So it's a very simple gauge, right? It's not as sophisticated as you have a FP&A guy to run all the analysis for you. What I'm trying to say is make sure you have sufficient cash in your bank account. So, whether you have any shock, for example, you have a big bill that you have to pay next month, you don't have to worry about it, right? You can spend most of your time and focus in driving your top line, your sales, your business.
Amazing. Thank you, William. We have another question here that's what should I prepare before switching my accountant? I don't know if you want to answer that one, Mohsen.
Yes, I could take that. Thank you, Naria. And it's a good question as well. Switching accountants is super straightforward. It's not as hard as what we think it to be, because we assume it to be very stressful. There's a few things that, as business owners, you should have ready. So it depends on who holds the information. And normally this is held by your accountants, but it's good for you to also have this, which is your most recent filed accounts, latest corporation tax return, any recent VAT return, and details of what day your bookkeeping is up to. So if you're using softwares like Xero or QuickBooks, just make sure you have full access to them softwares. You're able to add your new accountant on there as an advisor, which makes things super, super easy because everything can be taken on by them from there. Normally what does happen, and the good thing why a switching process is super simple, is because it's handled between accountants. So normally the new firm that you do engage your services with will reach out to your old firm, request professional clearance, where they will write to them, request all the information that they require. And normally the accountant will respond back with all the necessary information, provide everything, request the necessary authorizations from HMRC, and then proceed in terms of providing you accounting services. Do be careful though, and do check notice periods with your current accountants. Some firms do require notices or have certain disengagement clauses that you have to follow. So please do be mindful, and also be straight up and have that conversation with your existing accountant. Let them know, look, I'm thinking about switching to a new accounting firm. This is why. And this is where we're going. Is there anything that we need to do? Is there anything you need from me? So it's pretty straightforward. It's handled between accountants, but I just recommend have a conversation, put it out there and see what your next steps are.
Awesome. Thank you for sharing that, Mohsen. Okay, I think we're going to do one last question, and this one goes for Anthony. So the question is, are there any other forms of other third-party finance that can assist with cash flow?
Yep, that definitely is. I would say probably the main one that is easiest for cash flow is kind of like asset-based financing. What that entails is essentially a third-party lender loaning monies directly against the value of specific assets. So that could be stock, it could be plant and equipment, it could even be IP. And yeah, basically, it's very similar to invoice factoring in the sense of they'll do a valuation of that particular asset, loan to you, maybe 80% of the value of that asset, and then you've got that cash readily available, and they take a security over that asset. Only problem with asset-based financing is it usually is a little bit more expensive. There's usually quite a number of fees that are involved, lots of reevaluations of those assets on a regular basis that you're probably likely to have to pay. The interest rates also sometimes are a little bit higher generally from what I've seen, but still a very useful way to kind of get cash quickly against current business assets.
Amazing. Thank you, Anthony. Okay, I think that's the end of today's webinar. So thank you so much for joining us today. It's been a pleasure having you. And if you still have any questions, or for anyone who's watching this at a later date, make sure to book a free consultation call with our team, and they'll be more than happy to help you. Also, feel free to follow us on social media. We are at We Are Awesome on all socials, and we share daily business advice as well as relevant events that you might want to take part in. So make sure to give us a follow if you'd like to stay tuned. Thank you so much, and have a good rest of your day, wherever you are in the world. Thank you.